On the Edge. I'm Max Keiser. What a crazy week. Occupy Wall Street. Occupy the world. What about Occupy Washington State? Let's go to David Morgan from silverinvestor.com. David Morgan from Washington State, welcome back to On the Edge.
Max, thanks for having me back. It's great to be with you.
All right, David Morgan, there's a huge global insurrection against banker occupation, and underneath that, we see some interesting cross-currents going on as well. Now, you've just returned from the Utah Monetary Conference, where you signed the Utah Monetary Declaration. How exciting. Tell us all about it.
Well, Utah is the first state in the union that has, at law, passed the fact that citizens can voluntarily interact in any transaction in the state in commerce. So in other words, simply stated, you can buy and sell with gold or silver as a transaction basis throughout the state. Now, that is a little tough to do coin-wise, so they've implemented a strategy that I think is very simple and everybody's familiar with. You put your gold and or silver with the depository. The bank gives you a credit on their balance sheet. They issue a debit card, and then you just use the debit card. So to the merchant, say a Walmart as an example, you simply swipe your debit card. The transaction goes down on the spot price basis that day, whatever the spot price of gold or silver is. And then at the end of the month, they reconcile the account basis what you purchased during the month. So once this is implemented, I think it's going to catch on. And then, of course, it sets a standard, I think, for other states to come along and do the same thing. There are 11 states that have proposed gold and silver in transactions, but Utah is the only one that passed it into law so far.
If you have your account based in gold and silver and you're using it as your go-to savings account and checking account, you have protection against the government printing up lots of fiat dollars and inflating the purchasing value away from your currency. So why wouldn't anyone not want to do this?
I do believe it's going to catch on. It's hard to say. There's the argument about Gresham's law that good money chases out bad, that you're only going to save the good money. But I don't think that's necessarily true, and I don't have time to go into all the arguments. But I interviewed Larry Hilton, who wrote the bill. He's a lawyer in Utah. But basically, there's lots of reasons why you would want to use physical gold and silver in a transaction. One is some of the merchants will give you a discount. In other words, if you pay in real money, they're more likely to take a bit of a discount, just like paying for something, in cash on the spot. So present value of money. That's one reason. Second reason is these markets do fluctuate. And there are people that say, geez, I've got a real nice move here in silver. I think I'm going to take advantage of that. I want to buy, this Xbox or whatever it is, because now's the time. That's, my gut feeling or whatever. Lastly, and one I get all the time, Max, and I'm sure you get it as well, is, geez, I'd love to get in the gold and silver market, but how do I sell it? Well, now you don't have to sell it. You can spend it.
Yeah, exactly. And I think a lot of people who follow this space, that's their exit for gold and silver, is when eventually the whole world goes to gold and silver standards and you start to exit your gold and silver as you spend your gold and silver, because that's the new de facto global currency. Now, there is this global insurrection against banker occupation. We kind of started it a few years back in the work that we do here, and now it's spread all over the world. Folks finally understand that it's the banks. And the banks, of course, create all the fiat money. Now, if you were to talk to somebody from the Occupy Wall Street, what would you tell them about the benefits of gold and silver and how that might relate to their objectives?
I think the first thing I'd start with is a fact, and that is that there has never been a fiat currency in the history of mankind that's ever survived. So that implies right now that the fiat system is going to collapse, or collapse further is probably a better way to state it. And the second one is that gold and silver have maintained purchasing power for that same time frame. It does fluctuate in price, but it doesn't fluctuate in value over a long period of time. But that's it. I think to get the basic concept that we're on a path of fiat destruction, and it's continuing, and it's probably going to get worse and worse. And secondly, that the only money outside of the matrix or outside of the system or outside of the banker's hands that you can employ is physical silver and gold, and that can now be accomplished quite easily, or will be in this Utah bill. And I don't know if I'd bring that in, but that's the trend. Look at gold money.
Now, you were at the conference. You spoke on several panels, David Morgan, including one called Booms, Busts, and Monetary Policy. Explain the role of monetary policy in creating the current bust we see all around us.
Well, if you go through your basic high school or even college economics, what you're going to find is that there's two main policies that the federal government is in charge of. They do refer to the Federal Reserve, and they talk about fiscal and monetary policy. They talk about the role of the Fed, and they say, basically it's to maintain, low inflation and maintain a high growth rate in the economy. Stability is used over and over again, and it's laughable. I mean, this is what their mandate is, but it's anything but the truth. The truth is that they have a bias to inflate the currency into oblivion, and that's where we're at right now. And the Keynesian model is that when the economy goes poorly, what you do is stimulate the economy by throwing more money out there, either through the government sector or the private sector or both, and get things rolling again. Well, it only happens so many times, and now we're in a liquidity squeeze. They've got zero interest rates. They've got tons of funny money sitting there in banks, but the credit-worthy people that could borrow it aren't. They're sitting on cash themselves, and the people that would love to borrow more are not credit-worthy. So you got a ton of cash that's just sitting there doing nothing, and the system continues to deteriorate almost daily.
Okay, in the U.S., you've got free market capitalism, and you've got a monetary-based system run by the Federal Reserve Bank in Washington. And the theory is that inflation is okay. They'll keep printing dollars because if you inject a lot of currency into the economy, it makes credit easier to get. And it's a trade-off between the GDP growth you can achieve by putting credit into the hands of so-called entrepreneurs versus the loss of purchasing power that comes with inflating your money supply. And for decades, this argument looked good. There was a natural rate of inflation. Purchasing power went down every year, but so did GDP, though, however, increased. Then they got into some statistical gamesmanship, didn't they, David Morgan?
Absolutely, and you stated it better than I, Max. Thanks. Basically, people use that argument against me. Well, you guys have been saying this for years, and look, it's been good. Well, it's not good now. And I had to rethink that question. And basically, everything has a limit. There's a limit to how many times you can bend a wing before it breaks. There's a limit to how much fiat funny money you can pump into the system before people, especially sophisticated people, say enough is enough. We don't want it anymore. Whenever you have a lot of something, the value becomes less and less. Look at the Zimbabwe dollar. What most people don't know about that little video I did was that when the $1 unit or $1 bill from Zimbabwe, it was worth actually more than a U.S. dollar. And 18 months later, the printing of the $100 trillion note was so worthless that they didn't even get into circulation. That took 18 months. Now, I'm not saying the United States is going to have it go that badly, but the implication is certainly the same because the principles are the same. Print your way out of this. You cannot print wealth. If you could print wealth, Zimbabwe would be the richest place on the planet, and it's not.
Right. Well, at the moment, despite all of this printing of money in the U.S., the dollar is enjoying a rally against every major currency in the world, including it's making some headway against gold and silver. It's become the go-to currency around the world as we see a continuation of the trends first coming to the fore in 2008. The unwinding of decades worth of derivatives and debt, which is forcing people to jump into the U.S. dollar. And the question is this sustainable? Or are people going to find themselves in a few months' time, as they did back in the 2008-2009 period, holding a rapidly depreciating dollar against precious metals?
Great question. And hopefully, I think your audience is sophisticated enough to understand I'm not contradicting myself. For short periods of time, and that could be 3, it could be 6 months, we're going to see what I've been calling a deflationary scare, which is what you just described. And because the U.S. dollar is the reserve currency of the world, and you've got 7 billion people on the planet, you can actually print a great deal of money until it starts to, really deteriorate even more. In other words, the deflationary scare has brought a lot of money thinkers into the dollar as the reserve currency or as a stable currency, and it's more stable than the euro right now, and that goes back and forth and back and forth. So there could be a demand for dollars on a short-term basis, but longer term, the principles are still there, which means at some point you're going to see what you described as what happened in 2008 and 2009, especially among the nation states. It's not like China, Russia, even some of the IMF, even the UN, all of these have stated that they're looking for alternatives to the dollar. Well, why is that? It's because they know that the dollar's days are numbered.
Okay, let me play kind of devil's advocate here for a second, or give an extreme case. Let's call it hyperdeflation. The Fed is printing. The Fed would love inflation, but they can't seem to create inflation with QE1, QE2, Operation Twist, QE3 is on the horizon. They can't seem to create any inflation no matter what they do, because the housing collapse and all the mortgages associated with the housing collapse and all the derivatives associated on banks' balance sheets with the collapse of the housing market around the world is so great that there is no amount of money printing that will stop this deflationary crash, similar to what we saw in the 1930s. Now, I guess it's not really the devil's advocate argument, because didn't gold do very well in the 1930s as well, David Morgan?
Actually, yes. Professor Jastrom, The Golden Constant, the book he wrote, proved that gold does best in a deflationary environment. But we were also on a gold standard back then as well. So the argument you're making is used by my deflationist friends, and they say that, we're deflating, and we are. Asset prices are deflating. The money supply is still increasing, and the argument is that they're not getting any stimulus into the economy. It's true in the private sector, as I said. I don't want to contradict myself, but it's not true in the government sector. The fiscal policy is to keep creating more and more and more make-work jobs in the government. So if you take that to the extreme, it'll fail at the point where 100% of the population is working for the government, and all they're doing is printing funny money, and a lot of these jobs are, digging up holes and filling them back in again, as a metaphor. That's the direction that we're going. I mean, the government keeps expanding, which of course is the problem, or one of the main problems. It's government regulation and the size of government, but that keeps increasing, and that's where this money is actually going. They're able to get into the economy.
Okay, let me throw a metaphor at you for a second. I know your background is actually in the aviation industry, and one of the principles of flying, of course, is that the speed of the wind over the wing is faster than what you see under the wing. This is why the curvature of the wing is as it is, and this gives the lift, if I got that correct, which we now know, is the recipe for flight. In the monetary authorities, they're trying to fly the economy by creating the right speed of the forces of a high-speed monetary going one way versus the natural deflationary tendencies of cost efficiencies and productivity gains going the other way. Now, this is the theory, but the plane is crashing, isn't it? Isn't that so, David Morgan?
It is. I mean, even by the Fed's own numbers, the U.S. dollar from the time that the Fed started till now, we've lost like 96% of the purchasing power. And their mandate is to maintain stability. So if they really held to their mandate, $1 in 1913 would be equivalent to $1 in 2011, and it's not. It's worth about 3 or 4% of what it was then. I think if anyone really examined that in a short-term basis, in other words, went from 100 basis to 3 in a year's time, that would be hyperinflation. Since it's happened over 100 years or so, people are sort of like, well, it should be that way, or that's the way it just is, etc. No, it isn't, because the path is very clear which way it's going. And even with this deflationary scare that we're seeing now, which could maintain for a few more months, it's not going to correct the problem. There's 2 ways to correct the problem. One, you stop the quantity of money in its tracks and you make the dollar stable. You don't print any more, and you let the market clear. Everything that's too big to fail, fails. Every bank that was too big to fail, it fails. Let the market determine who wins and who loses. That's free market capitalism, but you don't see that on Wall Street. They say, wah, 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 we have to be bailed out. We are too big to fail. Well, you know what? That's not free market. The free market allows you to succeed and it allows you to fail. But then they changed the rules. Well, it's free market with a wink and a nod. And then they say we're too big to fail. The taxpayers have to bail us out.
Staying on this theme of monetary policy, you also spoke on the panel in Utah where they've legalized, or in the process of legalizing gold and silver as legal tender, a panel called In Search of a Monetary Ideal. And you spoke on behalf of state-declared legal tender, as we've been talking about. And is there a monetary ideal in your view, or is that simply a wild goose chase that is never achieved?
For me, the ideal is never achievable 100%. But there's two basic theories of money. One is a legal argument that money is whatever the legal system says it is, with power behind it, such as the U.S. government or the Federal Reserve. And if we just have the right quantity of money and no more, then things will be wonderful. That's one theory. The other theory is that specie money, gold and silver, what the free market has determined to be money for thousands of years, is the best money. I fall into that camp. And the reason being is that the growth rate for gold is about 1.5% a year. You have all the people that want sustainable growth. If the economy grew on a gold standard, it would grow basically at 1.5% a year average. It could go above and beyond that from time to time, but in the long term, it would basically grow at the same rate as the money supply. And bankers would be much more cognizant of their job of giving loans that they were almost certain would be paid back, not that there wouldn't be some mistakes. When an ideal, perfect economy, every loan is paid back, every, credit system that comes from the bankers would be complete. In other words, there'd be no failures at all. That's impossible. But the best way that history is taught is a specie money. When you go back to the benevolent dictator theory and say, well, we'll only issue the right amount of credit, we'll do these wonderful things for the population, we'll give them maglev trains and more dams and all this stuff that sounds really good, and I'm not against it per se, but it's in the hands of mankind. It's been proven again and again and again to failure, because what happens is political pressure comes into the mix, and then we need to go and do some boondoggle thing, and we need more government jobs, and we need more of this, and it gets voted in, and it's really not a good idea. Whereas with the free market, it may not be a good idea, but it's allowed to fail, as I said earlier, and it clears itself very quickly.
Okay, now having said that, David Morgan, you are nevertheless not a big believer in a gold standard. Why not?
Well, gold standard usually is the precursor to a fiat system. And I didn't write the series of papers, and I think it was a gentleman, Talga, I believe is how you spell his last name. And he showed a great study that he did that bimetallism, where gold and silver both are in the monetary system as a check and balance to each other, that you have a much more stable monetary system. The problem with the gold and silver monetary system is that usually it's by edict or government authority that they say that 15 ounces of silver is equal to 1 ounce of gold. You don't want that. What you want is gold and silver to circulate freely, and the market to determine what an ounce of silver is worth relative to an ounce of gold, and vice versa. And if that happens, you have a very stable monetary system. And the silver equation is important because it's outside the hands of the bankers. Once the bankers control most of the gold, then they can slowly move out of a gold specie standard where you're using gold coin, go to a gold certificate program, then go to partial gold covering, and go the way that we went in August 15th, 1971, where it was only settlement internationally, and then that gets shut down. So time and time again, a gold-only standard, believe it or not, history shows, turns into he who owns the gold makes the rules. Every case so far, the bankers own the gold, and they made the rules. And the rules are gold, gold, gold for a while, less gold, no gold. And so that's the reason that gold-only standards through history have proven to actually not work that well.
Right. Williams Jennings Bryant, the will not be crucified on a cross of gold. Refer back to that speech. That's what he was talking about. Now let's talk silver. Silver has been on a wild ride these past few weeks. The mainstream media is saying it was a bubble. The bubble has popped. Your view, David Morgan.
Silver did get ahead of itself, even in my view, and I've said it's going to $100 minimum, and I still believe that. But once we got into like the $25 to $50 range, it really accelerated. And, some of my peers and colleagues are saying, geez, you're not bullish enough. I'm saying I'm cautious. I don't care what the commodity is. When you see that kind of movement, you usually get some kind of a pullback or correction, which is what we saw. We saw us go to almost 50. It pulled back intraday to around 33. And then it built a base from around 33, 34, 35 level up to about 38. Then it started building a higher base from around 38 to 42. And then gold in the interim, as silver was building a higher base, made a parabolic move, not in the percentage terms of silver, but nonetheless, it moved fairly substantially from around the $1,500 level to the $1,900 level. That concerned me as well. Sure enough, we've got this September 22nd day that comes along, and all of a sudden gold and silver get just hammered. And it was about a 3-day waterfall decline. Yeah, we're still in the process now of determining whether this is a short-term bottom or a intermediate-term bottom. I lean toward an intermediate-term bottom. I think it's going to take time to rebuild and find a bottom and rebuild a base and then start coming back up. Longer term, nothing has changed fundamentally. In fact, fundamentally, it's probably the best time, if you're not in these markets, to start accumulating.
All right, we got about a minute left. I want to ask you 2 questions relating to J.P. Morgan. The reports say that J.P. Morgan holds 80% of all the gold derivatives, and HSBC holds about 20% of all the gold derivatives. Is that the sign of a free market, David Morgan?
No, not at all. And what's interesting is this lawsuit about silver manipulation. HSBC has been let off the hook. It's really against J.P. Morgan.
Right. I was going to follow up with this, that your thoughts regarding the lawsuit against J.P. Morgan for manipulating the silver market. Can you elaborate on this a little bit and tell us what all this means?
Well, it's a historic case, and what I'm concerned about is they've narrowed it down into one bank and one lawsuit. And so, depending on how the courts rule, it's sort of like a one chance only, whereas before I think there were 6 or so lawsuits, which was my preference because you have a lot of times to kind of nail this process again and again and again and again. And, sooner or later, I think some court is going to say, yeah, this isn't right. This smells funny. This is illegal, or this is manipulation. When you only have a one-shot deal, it concerns me. But they've got a strong case. We're just going to have to put our faith in the judicial system, and they're going to see it, they're going to understand it, and they're going to rule.
All right, David Morgan, that's all the time we have. Thanks for being on The Edge.
I'm on the edge, Max. Thank you.
All right, and that's going to do it for this edition of On the Edge with me, Max Keiser. I want to thank my guest, David Morgan. If you want to send me an email, please do so at ontheedge@presstv.com. Until next time, this is Max Keiser saying bye, y'all.